Morning, everyone. It's 10 o'clock, so we'll call the meeting to order. First order of business on today's agenda is to approve the minutes of the meeting of October 12th, 2017.
Move it. Second.
Have a motion and a second on item 2. All in favor?
Aye.
All opposed? Motion carries. Item 3 is a consent docket.
Move the item. Second.
Have a motion and a second on item 3. All in favor? Aye. All opposed? Motion carries. Item 4 is to ratify approvals. We have 3 items this month.
Move all 3 items.
Second.
I have a motion and a second on item 4. All in favor? Aye. All opposed? Motion carries. Item 5 is to approve the claims docket.
Move it. Second.
I have a motion and a second on item 5. All in favor? Aye. All opposed? Motion carries. Item 6 is to approve the following applications for service retirement. We have 6 applications this month.
Move approval.
I have a motion and a second on item 6. All in favor? Aye. All opposed? Motion carries. Item 7 is to receive the report of death, authorize payment of the $5,000 death benefit, and approve continuation of pension to the spouse. We have 1 case. We have a motion and a second on item 7. All in favor? All opposed? Motion carries. Item 8 is to receive the report of death and approve continuation of pension to the spouse. 1 case.
Move it.
We have a motion and a second on item 8. All in favor? Aye. All opposed? Motion carries. Item 9 is to receive the report of death, authorize the secretary to make necessary changes to conform on the following.
Move the item. Second.
I have a motion and a second on item 9. All in favor? Aye. All opposed? Motion carries. Item 10 is to approve the following application of vested rights. 1 case.
Move the item.
Second.
We have a motion and a second on item 10. All in favor? Aye. All opposed? Motion carries. Item 11 is to approve the request of the following to terminate vested rights and commence drawing retirement benefits. 1 case. We have a motion and a second on item 11. All in favor? All opposed? Motion carries. Item 12, investment consultant report. Good morning, Jason.
I have the quarterly report this morning. Certainly very good numbers. I thought I would take us back. So we're 10 years, almost 10 years from 2008, but I was looking back at some data that what I handed out, this 1-page thing. There was this was every day we put out a daily market update of the indices where things are. But one thing caught my eye on this yesterday, and then I went back and looked at some things. If you look down toward the middle of the page at rates, it says rates change in BP, that's change in basis points. The Fed funds currently, as of Monday, was at 1.25. The 10-year note was at 2.3. The far right shows the change in rates over the last 10 years. So the Fed funds is down 3.25%, and 10-year T-bills are down 2%. So if you add those numbers back to the current yield, the Fed funds rate was at 4.5% in November of 2007, and 10-year T-bills were below that at 4.3. So trading, the short-term overnight rates were trading at a premium to long-term rates. So an inverted yield curve, certainly indicating signs of a looming recession. I went back and I was just looking at quarterly books from that time, and the numbers, the returns at that point in time, in September of 07, were still very good. Your trailing returns, but it was you were starting to see some unbuckling of things. And I mention that not to say that our expectations today are that we're going to see what happened in 2008, but as we look at It's important to keep in mind that markets do change, and it's not a ride straight up like this. Volatility continues to be very low, indicating investors are pretty complacent. Fortunately, there has been some positive economic signs. Employment in the U.S. is at all-time lows. We're still not seeing positive wage growth. Earnings have been good. Corporate earnings have been good. The environment is conducive to growth, but valuations in the market are pretty stretched as we sit here today, and there's just not a lot of places to go. I'll point out a couple other things as we harken back 10 years. If you just turn to page 9 in the quarterly book, and you'll see for the trailing 1 year, this is the period ending 9/30. The bars on that page, the second section of bars there, bonds are basically returning nothing. The difference between stocks and bonds is about 18 to 20% difference in return between stocks and bonds. That's pretty significant. Large cap stocks outperform small cap, or small cap stocks outperform large cap for the trailing 1 year, and international outperforming the U.S. and emerging markets the best. If we just roll forward and just look at the calendar year, that's on the left there, you can see non-U.S. significantly better than the U.S., and emerging markets have done very well. And that's been primarily a currency. There's been good earnings outside the U.S., but also a currency impact as those emerging market currencies and non-U.S. currencies have rallied relative to the dollar. If you turn to the next page, just briefly, the other thing that we have seen over the calendar year to date is a huge dispersion between growth and value. So technology, healthcare leading the way for the year. The difference between growth and value in large cap is about 13%. The Russell 1000 growth up 20.7 versus the Russell 1000 value up about 8%. Financials and energy lagging in this environment. We saw financials outperform in the fourth quarter of last year, right leading up to and right after the election, but that's fallen off, and more growth-oriented sectors have outperformed. Within small cap, as well as non-U.S., it's a similar story. Dispersion in small cap is about 11%, with the growth index up 16.8 and value up 5.6. Within your portfolio, within large cap, the portfolio is pretty well style neutral. You have passive exposure through Intech and SSGA primarily. Within small cap, we do have growth and value complements. Over this period, your small cap performance has been outstanding, and it's primarily been driven by your value manager, Earnest. Earnest is more of a relative value manager, although they do incorporate growth as a component to their portfolio, so they don't look like a lot of value managers over time. And they've actually done very well. And Times Square has kept up, certainly. Just moving to page 15. And I've kind of already provided the spoiler on this, but we see where interest rates are today. The short rates have moved up a bit. The Fed did not raise rates at their last meeting, although the expectation is that they will raise in December. And current market expectations are for 3 hikes in calendar 2018. What we are seeing is a bit of a flattening of the yield curve, but certainly not looking like what it did in September of 2000 at this point. But market forces have kept intermediate to longer term rates down pretty significantly as yields globally continue to be very low. So the difference between the Fed funds and intermediate to longer term rates is still pretty narrow. So I mentioned in September of 2007, Fed funds at 4.75 and the 10-year at 4.50. 1 year later, in September of 2008, which was the peak of the crisis, Lehman collapsed in end of September of 2008. Fed funds was at 92 basis points, or the 90-day T-bill was at 92 basis points, and the 10-year was at 3.85. still significantly higher than where we are today. But I guess the point of all this is we've seen rates low for a long time, really pushing a lot of assets into more risk, a lot of money into riskier assets, equities, and other strategies. As we turn to your portfolio, page 20, on a dollar basis, you began the year at $663.1 million. Net additions, which is cash flows, contributions in less benefit payments and other expenses, negative $30 million, which is to be expected in a mature plan that you'd have negative cash flow. Return on investment for the year is $80.8 million. So the portfolio at the end of September was at $713 million. At the end of October, you're up another $9 million at $722 million. Just, again, to put some things in perspective, in September of 2008, so this would have been right at the peak of the crisis, the assets were at $466 million in the plan, down from $538 million at the beginning of that year. So at the beginning of 2008, the plan stood at $538 million, down about $65 million over that 9-month period. That can happen. It's important to keep that in mind as we sit here. What you have is a very diversified portfolio. We talk about this a lot. We're trying to participate in up markets, but not necessarily chasing returns, not chasing returns at all, and keeping cognizant of risk. And you've been able to do that. As we look at page 21, this is just relative results versus some primary objectives. Over the last 5 years, the annualized return of the fund is a little over 9% relative to your actuarial hurdle of 7.4. So over this 5-year period where markets have been good, you've been able to outperform that pretty significantly. Over a 10-year period, we're lagging because that 2008 still in those numbers. If we looked at a 9-year number, and I think probably a 10-year number it's probably another year away, March of 2009, before we see that 10-year number moving back up over the 7%. But all of the risk measures, which are below, so volatility, standard deviation as a measure of volatility and risk, beta, a measure of sensitivity to the direction of the market, and then performance in down markets, of which we haven't had a lot recently, but over a longer term we have. Your portfolio is demonstrating lower risk, more conservative approaches, which is what we're certainly trying to accomplish. Since September of 2008, in September, really going back a little bit before that, the beginning of 2008, mid-07, you had 10 managers. Today you have 18 managers. So you have become more diversified over time. And so some of that is to garner return opportunities, but it's also been to reduce risk and make the portfolio more efficient. So over that time, in 07 and 08, you did not have emerging market allocation, no private equity, no commodities, no opportunistic real estate, or global bonds. All of those things have helped to benefit the portfolio over the last several years, and we would also expect the diversification benefits of that to benefit you in a more challenging environment.
Jason, I have a question. Talking about investments, we received an email about the House Ways and Means Committee and the tax reform legislation that certain state and local government investments may be subject to the unrelated business income tax. Can you speak about that? Are you aware of that, or can you speak about it a little bit?
I can't speak about it well. I can speak to you about what I think. Historically, that has been something that state and local governments or government plans have potentially been exposed to having to pay tax on UBTI. So when you invest in certain hedge funds, certain private equity or real estate structures, my understanding from talking to tax people like Cindy Burley and others is that the public pension plans have taken the position, we don't owe tax. So even if they incurred UBTI, they haven't filed a tax return or paid it. I think this legislation would probably be such that it would crack down on that. So there are vehicles, there are ways, and the endowment foundation space, the other tax exempts, not governmental tax exempts, but other tax exempts have addressed UBTI, and it's really more to address the administrative burden of having to file a tax return through investing in what they're called blocker vehicles. So as opposed to investing in a U.S., I'm not sure if you're K2 or PAMCO, I think they might be Delaware LPs. So the flow-through could be considered UBTI, which you've probably ignored up to this point. A way to avoid that administrative burden would be to invest in an offshore or blocker entity, which you avoid receiving the unrelated business tax income, but it reduces the return because it's being paid out at the corporate entity, that level.
Well, I know one of the things that they're looking at is making it retroactive. And I don't know the time period, how far back. I did forward that information to Wiley, and we're looking at some things, but that was kind of alarming to see that they were looking at making that retroactive if it were to pass.
Yeah, I don't know what the impact would be in this portfolio. We'd have to look at that. I don't think it would be huge dollar amount. I would have to look at what vehicles that you're in to determine the impact of that.
Right. We have Cindy Birdie's also looking into it for us and kind of letting us know what she's seeing on her side, meaning her talks with different legislative venues and what her beliefs are. So we're in correspondence with her over this issue.
So if you will, turn the next page just looks at the asset allocation, and then page 23 is the page that we've included just to show you on a look-through basis all your exposure to emerging markets from a risk standpoint. But I think it's important to point out today, emerging markets have been the best performing asset class by far, and so you've actually received a benefit from this exposure. That's why it's pushing up a bit of your total portfolio on a look-through basis. If we look through on the hedge fund investment, the developed international, and then on the fixed income side, you have a little over 10% in emerging market exposure, 6.5% of which is equity, and a little under 4% is on the fixed income side. This has been added. It's high today because those markets have done well, but certainly within your guidelines. Next, page 24 looks at, again, overall results on near term on the right side of the page, 1, 3, 5, 10 years. The one-year return is 12.6% as of the end of September. That ranks, that 39 is the percentile ranking in the public defined benefit universe. So relative to other public pension funds, you're in the top 39%. It's good to see above median return rankings, although I would say we know that you have a little bit less risk in the portfolio. You're close to, if not over 100%, you're over 100% funded now. So we don't necessarily need to take on a lot of risk. If you have your house paid for, you don't necessarily want to take enormous amount of risk. Relative to peers, you're on the lower end of the risk spectrum. And we can see that on a 10-year basis. If we look at the standard deviation of your portfolio, 8.7 versus the median peer of 9.48, quite a bit less risk than the median peer, and also quite a bit less risk than your policy index or asset allocation would suggest. So overall, portfolio is doing well. Just quickly turn to the ASAP, rolling forward a month. From an asset allocation standpoint, continue to be overweight to equities as equities continue to run up. That's the area where we're trimming from to meet your operating needs. I think we've been taking a little bit from small cap. Now large cap is the most overweight in your portfolio, 3% overweight. Small cap still 2% overweight. we did take from Western last month because fixed income got over target. But now we're back in line, a little bit more overweight to equity. So I would suggest we go back to large cap, the S&P 500 fund. Page 2 of the ASAP, a good way to look at where returns are coming from. This, again, we've rolled forward a month. So the one-year trailing return now as of October 31 of the total fund is 15.6% gross of fees, 14.93 net of fees. So even the net of fee return is above the policy index by about 10 basis points for the year in a good market environment. You can see if we go down by asset class, large cap, so the combination of SSGA and Intech has added about 2% relative to the S&P 500. Small cap, the combination of Times Square and Earnest, has added over 3% in a very good market environment. Private equity and the hedge funds lag the long-only markets, which we would expect in this type of environment. Private equity, just from a valuation standpoint, lags public markets, but longer term, you've certainly received a benefit from the private equity, and that portfolio is continuing to mature. It's being more additive from a return enhancement. International, good return, slightly below the benchmark on a one-year basis, and that was more from the fourth quarter of 2016 was pretty challenging for Lazard, if you may recall. They had significantly underweight to European financials, which hurt, as in the fourth quarter of last year, European and non-U.S. financials rallied along with U.S. financials after our election. But year-to-date, pretty significantly ahead, about 3% ahead year-to-date, the combination of Harding Loevner and Lazard. And then your emerging markets are up 32% on a one-year basis, getting good returns there as well. Relative to the policy index, fixed income continues to be very strong. Even though the absolute return is only 4%, you can see what bonds have done. Bonds are essentially flat, up 90 basis points in the year, but you're getting good positive returns, and that's coming from both the Western Core Plus portfolio and the Brandywine strategy, which is pretty significant exposure to emerging market debt, where you're getting the benefit from a currency and a yield standpoint without necessarily taking on you're not taking on equity market risk. So overall, I started out just by hearkening back to 2007 and 2008 because I think those lessons are important to keep in mind. One of the lessons we learned was we didn't change then. We didn't bring in risk after the events of 2007 and 2008. You have a plan. We want to stick with that plan, but we also need to be cognizant of markets moving up too much, that there could be a correction, and we want to stick with the plan and maintain good diversification across the portfolio. No manager issues. There has been some turnover at State Street in the senior management of the firm. We really view State Street as an index provider. It continues to be one of the largest index fund providers in the world. It's really much more of a commodity. We're not too concerned about changes in upper management there, change in direction. What we're looking at is size of assets, fees, making sure that the fees continue to stay very low, and their ability to track the markets, which they're doing. So no concerns about any of those issues there. With that. I know at the conference we did have the session on hedge funds, and we want to continue that discussion with you, potential implementation changes there. As we mentioned at that meeting in September, K2 is still in the process of finishing up the construction of this platform, this feeder platform. There are 8 funds on the platform today available. They should have more than 10 by the end of the year. And what we said would be our next step is to come back to you with a potential proposed portfolio structure using that platform. So what we're suggesting is we probably wait till after the first of the year in January to come back with what that would look like, and also have K2 in at that time to talk about their platform.
Any questions for Jason? Thank you, sir.
All right, thank you.
Item number 13 is comments from board, staff, and citizens. Everybody have a great Thanksgiving. And with that, we are adjourned at 10:26.